Welcome to Tax Smart Hustlers, where each episode unveils powerful tax strategies and financial wisdom for the go-getters. Hosted by Thrive Tax Solutions, this podcast is a gold mine for small business owners and real estate investors seeking the path to financial freedom. We dive into practical, actionable advice on optimizing taxes and accelerating wealth growth. Join us to become a tax smart hustler.
And welcome to episode 4 of the Tax Smart Hustlers podcast. My name is Siegel, and I'm a tax strategist at Thrive Tax Solutions in Boulder, Colorado. On today's episode, we're going to be talking about something that impacts anyone who's converting a Schedule C business into an S corporation, and that's the mechanism in which we would reimburse employer-related expenses. So with that, there's a mechanism called the accountable plan, which applies when you make that conversion from Schedule C to an S corporation, and we're going to break that down for you today. So first, what's an accountable plan? If you have started yourself an S corporation, which makes a lot of sense for tax purposes, it also introduces some additional requirements. So what the IRS requires is that you have this mechanism called an accountable plan that allows you to reimburse your business expenses without triggering income tax on that reimbursement. By default, without this plan, the IRS says, sure, you can go ahead and reimburse your employees for the expenses that they've incurred, but it's going to be included in their payroll and subject to income tax. Obviously, that's not the thing we would want to do to really minimize our tax burden. So the IRS says you can create this accountable plan. It doesn't have to be in writing, but it does have to be a formal policy, which is a little bit contradictory, so you probably want to get something in writing to cover this. But that allows you to avoid having to include these reimbursements in payroll. There's a few requirements for where employees have to make these expenses make sense for the business. So the first and the obvious one is the expense has to be connected to the business. So you can't go reimbursing personal expenses out of your S corporation. You have to substantiate the expenses, which means you have to have receipts or a proof that you've actually made these different payments. And then the third rule is if you do choose to reimburse things in advance, which is allowed under the plan, any excess payments have to be refunded to the business. The first thing here is if you have a business expense and you have a business bank account, it makes a lot more sense to pay the expense from the business bank account. A lot of times where these accountable plans come into place are typically expenses that are commingled, right? So we'll talk about home office, car expenses, cell phones, internet, those types of things where you might pay primarily for personal use, you would pay out of your personal account. And that's really where this accountable plan is meant to come into play. There's a few timing issues in terms of these reimbursements. The IRS typically requires that you're going to reimburse within a few timeframes. So we've got this 30, 60, 120-day rule. The first is you can reimburse expenses in advance, but only 30 days in advance. If you have a big expense that's going to come up in the personal account, you can reimburse these expenses up to 30 days in advance. On the backside, so if you pay for these expenses out of your personal account and want them reimbursed, typically that reimbursement window is 60 days in arrears. So you have to be keeping on top of your expenses and documenting these as you go so you can meet that 60-day requirement. Then the third is if you do take advantage of that 30-day in advance repayment, if you've reimbursed too much, so let's say you thought the expense was $1,200 and it turned out to be $1,000, you have to reimburse the balance back to your corporation within 120 days. Otherwise, you've essentially violated these covenants or restrictions that are in place on the accountable plan, and it can jeopardize the ability to use that plan. So some of the common expenses that we see in these accountable plans are the car and truck expenses, home office expenses, travel expenses where maybe you're mixing some pleasure along with the business, and then shared cell phones or internet. That tends to be the 4 big ones as far as these expenses go. So we're going to break them all down. The first one is car and truck expenses. So generally, you're either going to be taking your standard mileage rate or your actual expenses for your vehicle. And when you had a Schedule C business, usually you didn't have to make much in terms of documentation along the way. So you kept your mileage logs. You could essentially commingle these expenses and just deduct it on your tax return. But as we transition to an S corporation, it becomes much more important that the corporation actually has to reimburse these expenses to ensure that they're valid and deductible to the S corporation. If you haven't been good about your mileage logs along the way, I'm sure there are many people out there that fall into that category. You really do need to stay on top of the mileage logs. It's because of that reimbursement window being 60 days. If you're not keeping track of these miles as you go, you're really jeopardizing that accountable plan because you're not making timely reimbursements of the mileage. The other fun nuance with this is there's this caveat when you reimburse with the standard mileage rate that a portion of that mileage reimbursement rate is actually depreciation on the vehicle. And what people commonly ignore, tax professionals being the same way, is that depreciation is actually subject to recapture when you go and sell the vehicle. A lot of times what you'd want to do if you wanted to be above board and follow the rules to the letter, you would go through and actually track the mileage and the reimbursement portion that is allocated to depreciation as you take it. And when you sell the vehicle, it is subject to a recapture tax on sale. So again, this is one that I would almost argue is relatively universally ignored, but it does make sense, especially if you have high mileage or you have a high value vehicle where you've been taking depreciation allowances over time. It really does make sense to track that and do things the correct way. Now, the second one is going to be home office expenses. And we'll probably do a separate episode here when we talk about a home administrative office. So if you're renting an office elsewhere and you're doing work from home, it's similar how this works. But ultimately, we're still going to use the same guidelines that we would have used when we had a Schedule C business. So you can use that Form 8829 to really go through and break out the calculations for what that home office expense would have been as a Schedule C. But then when we have an S corporation, we're not going to include it as a part of either return. So what we'll do is we might use that form to calculate the allowable expense, but then we're actually going to reimburse it as a part of this accountable plan that we've built out. A couple rules here. One is that if the expense that you're looking at that relates to your home can be separated from the business use portion of your home, we don't want to include it for reimbursement, as tempting as that might be. Common things would be lawn care or pool maintenance, things where there's really no nexus to the room inside of the building that you're renting. Typically, we don't want to try to reimburse those expenses. They'd be commonly disallowed under an examination. The other is that we do still have to take depreciation on the home. So the portion that we're using for our business, you still have to take what would be allowed or allowable depreciation. Commonly, a mistake tax preparers or individuals who prepare their own taxes make is, I just won't take the depreciation. And so that way I don't have to pay the recapture tax later on. The IRS rule is twofold. So it's allowed or allowable. So if you don't take it, the depreciation is still allowable by the code, which means you'd still have to recapture it when you sell your house. So it really makes no sense at all not to take the depreciation, even though that's an additional step that you're going to have along the way. What you're going to end up doing is you're going to calculate the depreciation amount. And you're going to take that as an expense. It will be reimbursed from your S corporation to you personally. Your tax preparer hopefully would be keeping track of that inside of a fixed asset manager as they're preparing your taxes so they know how much depreciation has been taken along the road. And then when you go to sell your house, that depreciation is going to be subject to recapture tax. And that actually occurs before you get your home sale exclusion. So it's not one that you're typically going to be able to avoid when you have a disposition of your primary home. But you've got a benefit now, and generally that's going to pay off compared to that recapture tax that would apply down the road. Now, the next one is really about shared expenses. And this one applies to Schedule C businesses. It applies to S corps, really anything where you're mixing a little bit of business and pleasure. So the general rule of thumb is be reasonable with your allocations, right? If you have home internet and you're claiming 100% of that for your business, that's probably not reasonable, especially if you have kids at home who are streaming video and playing games and doing all of the things that kids do on the internet. Really, when you look at the percentage of data that's being used in the house, it's probably very high when you allocate that to the kids. So just be reasonable. If it's going to be something where 30% of that is business, okay. But again, look at how it's really being used. Be reasonable about it. It's not worth opening up an examination with the IRS where then they're going to turn around and go into all of the other areas of your business because you got too aggressive on the $40 Comcast bill. Be careful. The other one, it relates to cell phone usage. Just from a sanity perspective, I would highly recommend that you have a separate business phone line, even on your cell phone. Most of the iPhones and Android devices these days support something called dual SIM technology, which basically means you can have two phone lines that are on the same device. A strategy for this is really simple. You can go to a lot of these things called the MVNOs, so it's a mobile virtual network operator, and they partner with the larger firms out there like the Verizon or T-Mobile or AT&T, and they offer wholesale pricing typically, so you can get a much better price on these eSIM or secondary lines. So the strategy would typically be this, is that you would go and get yourself a personal line through one of these carriers like Tello or whoever else, and you're going to have a minimal data allocation, and that's going to support your visual voicemail. So you might have unlimited minutes and let's say 500 megabytes of data. That can cost you as low as $8 to $10 a month. Then your business is going to pick up a second line, which is going to have your unlimited data and your minutes and everything else. And generally, if you're using that for business use, that line becomes 100% deductible. The reason being is that you have a separate phone line that's dedicated to your personal usage. So that's really the key to getting the maximum value out of this is you're sure if you want the line from Verizon and want to pay that price, have your business fund that line, but you need a secondary line that you're going to use for your personal use. And on that one, you can go cheap. Go inexpensive, get what you need to cover the ability to make phone calls and have a minimal amount of data so you can go through and use your visual voicemail. But at that point, you have a clear separation of the two lines. If you don't do that, again, you have to go through and allocate the cost. So you're going to determine how much of your cell phone line was personal and how much was business. And as you could guess, if the IRS were to choose to examine that deduction that you've made, they're going to get copies of your phone bill. Honestly, they'll probably sit there and just start highlighting, okay, what's this phone number? What's this phone number? And just work through the bills. And what they're going to do is determine what was the actual percentage. So if you make call it inaccurate guesstimate, they're very likely going to adjust, if not disallow the deductions. So again, the easiest way to avoid this is just to have a separate business phone line. At that point, you've got one for business, one for personal use, you're good. But otherwise, take the time to really figure out what's the true percentage of what you're using in the business. Don't be super aggressive with this. It's just silly. You don't want to get an examination for something that's $20 or $30 a month. That's going to open up your entire business to an examination potentially. So again, just be careful, be reasonable. Now, the other one that's a kind of a big deal here is when you're paying your own healthcare benefits. If we're owning our own business and we've grown this side hustle to a main hustle, and we're looking to go and have an S corporation, at that point, we probably still need health benefits, right? If we're buying from the marketplace or on the exchange or even just privately placed health benefits, we need to make sure that we can still deduct that. And one of the things that happens when you convert to an S corporation is that the health insurance premiums that you had been paying personally are no longer deductible unless you follow some steps. You really want to shift those benefits payments to be paid by your S corporation. So if the S corporation is paying things directly, it's covering one of the two prongs. The second is that when you run your payroll, those premiums are going to be included in your wages on your pay stub. So what's interesting with that is it does come in on the income tax line and is subject to income tax, but it's exempt from FICA and Medicare tax. When you make that payment, it reopens the ability for you to then deduct those premiums that were included in your taxable income as self-employment related benefits. So it's a little strange. You would think, oh, okay, I could just pay this out of my personal bank account and be okay. But since now your S corporation is a brand new entity, it does require separation and the payment needs to be made within the corporation. It seems silly, but it is important. So if you're currently not having the S corporation pay those benefits costs directly, you do need to use the accountable plan so that way the reimbursement can take place, and that will continue to allow you to deduct these things off your income tax return in the future. All right, there is the whirlwind journey of accountable plans. A lot of times people talk about this S corporation conversion, but they really don't spend the time to educate the people who make the conversion about the rules. And the accountable plan is super important because once you have the corporation in place, you really can't commingle things like you might have been used to in the past. So always when you have a business, we say you should have separate personal and business bank accounts. It helps for legal purposes, if nothing else. But once you have an S corporation in play, you really have to be careful about how you're tracking and reimbursing yourself for these expenses. Definitely talk to your tax advisor if you don't have an accountable plan in place and get that going now. We want to make sure that you're compliant because if you were subject to an examination and you're not following this process, it can end up being pretty costly when you look at all these reimbursements that are coming through the S corporation. And if they are subject to income tax and it hadn't been paid, ultimately you could open yourself up to a pretty big bill over time. Talk to your tax advisor. Feel free to reach out to us if you have questions or you want to connect about it. We're on social media on all the platforms at Trust Your Taxes. You can email us anytime at hi@taxsmarthustlers.show, or you can visit the show website. It's just taxsmarthustlers.show. And as we continue to grow, it's been fun to reach out and connect with some people who have been listening. That's been awesome. If you like the show, give us a 5-star rating. It's going to help us continue to grow and get the word out to folks. And we'd like to hear what you'd like to know more about. So when you go to the webpage, it'll ask you, what did you enjoy about the episode? What do you want to hear about next? We really do want to hear about it so we can continue to bring you valuable information that's going to benefit your business as you keep growing. I hope you are all having an enjoyable start to the week here. We've got some pretty cold weather out in Colorado, so if that's what's going on for you, I hope you stay warm. But otherwise, keep on hustling, and I will see you next week.
The information provided in this podcast is for educational purposes only and should not be construed as professional tax advice. Consult with a qualified tax advisor for personalized guidance tailored to your specific financial situation.